of macroeconomics to determine how the news applies to real estate investing. My goal is to help you stay informed, make better decisions, and of course, make more money. So let's dive right into it. Some juicy stuff this week. Last Wednesday was the Fed decision. Jerome Powell lowered interest rates by 25 basis points in the United States. Let's check this out. It was the first lowering of interest rates since the Great Recession in 2008. And what they're doing is they're claiming that this is to help stave off a possibility of an economic downturn. It's interesting how the Fed now is in the business of smoothing out the entire business cycle as to make it seem as though it's not a thing. It's just really shocking to me. But let's go ahead and go on about what happened. When the Jerome Powell came out and addressed the media, he had his prepared notes there, and he was reading off the notes where he became rather hawkish and said that this was by no means a suggestion that the Fed was entering into a long period of lowering interest rates where it was a cycle and they'd get down to the lower bound, that this is just kind of a mid-course correction. Of course, not because the United States economy is weak. No, they'd never admit that. But it's those crazy foreigners and it's all the rest of the world. They're the ones that are all screwed up. So we've got to lower our interest rates to make sure that the world doesn't implode type thing. So that was kind of the story, but the markets didn't like this at all. They completely tanked because they wanted more QE. They want more, or they want lower interest rates, longer term. They were expecting the Fed to come out and be quite dovish. So markets tanked, and then right in the middle of him addressing the press, he kind of turned more dovish. He said, well, I didn't really mean it. I didn't mean that we couldn't go down and reduce interest rates in September. We'll have to be data dependent. We'll have to be all these things. So it's almost like someone kind of passed him a note mid-session, is like, dude, put a can on it, put a cork on it. You just tanked the market. And we need asset prices high. That's what the U.S. economy is based on. It's based on three things: asset prices, debt, and confidence. Remember that. That's what the U.S. economy is built on. So they've got to be cognizant of all three of those things. If you look at the U.S. economy or anything the Fed does through the lens of those three things that I mentioned, that is asset prices, debt, and confidence, it all pretty much makes sense. So market tanked, came back dovish. Market liked that a little bit. And the next day it went up a little bit more until Donald Trump came out with a tweet regarding the China tariffs and increasing those, and then the market tanked again. So it was just kind of this roller coaster ride. But how does this pertain to real estate investing? Whenever rates go down, the Fed has obviously total control over the short-term rate, the overnight rate, but it claims it doesn't have much control over the long-term rates, the 10 and the 30-year, but they do. And especially if they're buying the bonds, it's just quantitative easing. So the 10-year did go back down. I think it's now down under 2%, which is really crazy because that means mortgage rates will be down in the threes again. And generally, the reason for targeting lower interest rates, especially on mortgages, is to pull demand forward from the future. And that's, in the Keynesian mind, tends to buffer that recession. So as the economy would normally go into recession and retract, then you have all this demand that you're pulling forward from the future. It smooths it out, and then there's a little bit less demand in the future, but hopefully growth compensates for that. So that's the idea. But we had 10 years of zero interest rates, or in real terms, we had 10 years of negative interest rates. We still have negative interest rates. So, how much demand can you possibly pull forward? And when I say we still have negative interest rates, I mean that if you look at the real rate of inflation, the government tries to kind of fib the numbers down lower than they actually are. If you look at the inflation rate adjusted for the same metrics that we had, say, in the 1970s, or even in the 1980s or 1990s, then the inflation rate would be higher than the interest rate. But regardless, so we've got very low interest rates, had literally negative real rates for 10 years. Now, in my opinion, we've got negative real rates, but that's brought a lot of demand forward from the future. How much demand was there? And especially now with housing being, higher than it was in nominal terms in than it was in 2006, and in a lot of cities it's higher in inflation adjusted terms. So, how much of the smoothing out of that curve can you get? And a lot of real estate pundits are saying, well, this is great for housing prices, it'll send them up because mortgage rates will go down, therefore the monthly payments will go down. Then usually I would agree, but I don't know in this case, just because, again, how many buyers are out there at these prices regardless of interest rates? So that's kind of where I look at the Fed lowering of interest rates. And now, if we continue this trend, I think you really need to pay attention to September, which is the next meeting. And if they lower interest rates there again, and it looks like a cycle, then I could backpedal here and I could have a more bullish stance then. But let's wait till then and see. So the next thing that I wanted to talk about here are the zoning laws in Minneapolis. This is apparently the first, and let me go to this article here. I go to these articles so you guys, if you want to go read them, you can just look at the URL here and go over there. But this is from the New York Times, and Minneapolis tackling housing crisis and inequality, votes to end single family zoning. I don't know how that really tackles inequality, but okay, fine. I won't really get into that. But really, these zoning laws, that's interesting. So as someone who's a free market guy, I kind of had to let this sink in. I'm like, well, I don't mind that. I think this is good. Why do we have these single family zoning laws in the first place? I mean, if you own a piece of property, shouldn't you be able to put whatever you want on that property? And I get it. People don't want an apartment complex right next to their house or whatever. Well, that's why we have gated communities. That's why we have HOAs within communities, and there's several solutions for that. But I think this is a neat idea in the sense that, if you've got a huge house, I mean, let's look at Kansas City as an example. I know that market so well. There's a ton of areas downtown that are really old and dilapidated, but they have all these homes that are really the giant, 5,000, 6,000 square foot homes that are right downtown that were built in the 1900s or the early 1900s. And, they're just, it's a bad area. It's kind of ghetto. Well, listen, if I can go in there as a real estate investor, and if I can turn that from a single family, and if I can, let's say it's a 3-story building, if I can just create 3 units from that 3-story house and rent them out on Airbnb, let's do it. So you're going to have a ton of money come in, and the area gets better, it improves, and it's just a win-win for everybody. So I really like this. And as real estate investors, I think that we should pay attention to this trend. Housing is not getting cheaper, especially for the millennials. Even though the interest rates are coming down, they're basically 5,000-year lows worldwide. The housing prices have gone up so much, especially for starter homes, and the millennials have so much debt, so much student loan debt, and it's just it's a very difficult situation for them from a financial standpoint to actually purchase a home. So this could be a really great solution. And I think that as the pressure is applied to the politicians through the millennial vote and through younger kids, they're the 20-year-olds are going into the 30-year-olds and 40-year-olds, as they tend to vote more with age, you'll see this becoming more popular with cities. So pay attention to this. And if it comes to a city near you, try to pre-plan and figure out as to how you might be able to take advantage of this. So that's the news. I'll look forward to seeing you guys next week. Subscribe to the channel if you guys like the content. Remember, on Monday, Wednesday, Friday, I go over the macro news and how it applies to real estate investing. On Tuesdays and Thursdays, I go over kind of tips and educational videos. And then on Wednesdays, I come out with the George Gammon vlog, I guess, which is a look at my week, or better yet, kind of a behind the scenes look at what it's like to be a real estate investor in Medellin, Colombia. Now, just because I invest in Medellin, I've invested all over the world. I've invested a lot in the United States. So what we discuss on that vlog is not only entertaining, but it definitely pertains to real estate investing wherever you may live or wherever you may invest. So hit the like button, hit the subscribe button. If you guys have any questions, make sure you leave them in the comments, and I will see you on the next video.